All right. So can they still hear me? The Zoom. Do you hear any feedback from Zoom?
We can hear you.
Oh, awesome. It comes through the speakers. All right. Well, thank you everyone for having me. My name is Elvis Pinos. And before going through collateralized loan obligations, I would like to give you a little bit of background on myself. I came to William Patterson in 2010, graduated in 2014. I was a big part, like a lot of that I spent here in the trading floor. I worked for Peter as a, what was it, technology assistant, right? Consultant, technology consultant. I was also part of the student investment club. I helped around with the portfolio, with the student managed portfolio as well. And during my junior and senior year, I did several financial competitions. One at NYSA, which is the New York Society of Security Analysts. Those are the ones that certify the CFAs. And one at Seattle Pacific, where we actually ended up going to the finals to Seattle. So that was great. Oh, there you go. Thank you. And once I graduated, well, in my last year, in my last semester of my senior year, I got an internship at Carney Bank. So I was doing that part-time while coming to school, while doing another competition, while working as a technology consultant. And Carney offered me a full-time position. I stayed with them as a junior investment analyst. I helped manage the bank portfolio. The bank invests in mortgage-backed securities, in student loans, in corporate debt. They also buy loans, and they also did collateralized loan obligations. And this was something new that they were doing. Not many banks do that, at least not the size, the banks that were the size of Carney Bank. And that is because CLOs are very complex and they have a bad reputation, but they're really not that bad. And after a year at Carney Bank, I really enjoyed working with CLOs, and I decided that I wanted to do that. So I ended up getting a job at Guggenheim Partners, which is a big investment manager. They're pretty renowned with CLOs. And so I ended up going from Kearney, New Jersey to Guggenheim Partners, right on 42nd and Madison. And I did that for about a year or two. I first worked with CLOs, and then they put me to work with private funds, which are like CLOs, but more complex. And I can give you some examples of how they are different later on. When you work with CLOs, you're working, well, first, let me tell you what is collateralized loan obligation, right? So a CLO is just an investment vehicle, just like any other entity, where you have the assets on one side. In this case, the assets are, in my example, $400 million of B-rated loans. And then the liabilities on the other side. A CLO is made up of debt, which are the tranches from A through E, and equity at the bottom. So both of them add up to $400 million. The assets equal liabilities plus stockholders' equity. Same principle here. But what makes the CLO interesting and complex is the structure. If you look at the example, the structure of the CLO is divided into tranches. So the A tranche, B tranche, C tranche, all the way down to the equity piece. And the interest payments and principal payments flow from the top to the bottom. So the most senior gets paid first. The equity pieces, they get whatever is remaining. The losses, however, flow from the bottom to the top. So if there are any losses from the assets or from any loans that are held, the bottom tranches take the loss first, which provides protection to the more senior tranches. Now, this is important because that's the whole structure of the CLO is what gives the CLOs their ratings. Once you start structuring the CLO, you're working with an indenture, which is something like this. This one is about 250 pages. This has all the information on the vehicle. So on the investment vehicle, it tells you how to structure it, what type of tranches you have. Here you have an example of different tranches. everything about the structure is in here. So my job was to model it, to take whatever was in here and build an Excel model that reflected the investment vehicle. So everything about it, I had to learn it and make it into an Excel model. So Excel modeling is very important. I can pass this around for you guys to see. There you go. Yeah. So that's an offering memorandum. You can find them if you do like some Google searches. So I was talking about the CLO structure, and that's why you can get a whole bunch of loans that are all B rated, right? Which is not a very good rating. And you can get a structure where you have the A tranche that is AAA rated, a B tranche that is AA rated, C tranche A rated, and so on. The ratings drop based on seniority. And at the bottom, you have the equity piece, which has no rating. And how this works is by giving the A tranche seniority, right? If you look at here, the credit enhancement is of 30.5%. What this tells you is that if you sum all of the tranches under the A tranche, all of that adds up to 30.5% of the entire $400 million CLO. So for the A tranche to take a loss, 30.5% of the CLO has to take a loss first. That's why this piece can get a AAA rated, like a AAA rating. Depending on the risk, you have different spreads. So the lower the risks, lower spread. In my example, I have 40 basis points. Tranche B has 75, and so on all the way to tranche E, which gets 600 basis points, and that's over LIBOR, generally 3-month LIBOR. Basis points. That's another way to talk about interest rates, and that is on top of whatever the interest rate is of LIBOR. So you just add them together.
Is it basis point 1,000%?
Think so. I don't. Yeah.
Yeah.
So instead of putting it as a percentage, you put it as a decimal. So that's what it is, right? And what you generally do is you add it to the LIBOR rate, and it gets reset every 3 months. It resets, and that's how much the A tranche gets paid. The over collateralization test is very important for the CLO because these numbers are hard coded. Now, if you look at the indenture, those numbers are negotiated, these percentages, and that tells you that the over collateralization test cannot fall below, for the A tranche, for example, 126%. Now, what the result in my example here is 142%. Now, that just means that you take $278 million. I'm sorry, you take the entire proceeds and all of the collateral available in the CLO, you divide it by 278 million, which is the A tranche, and that accounts for 100% of the A tranche plus an additional 42%. So you're actually very protected if you are the A tranche. If you go to the right, as the tranche goes down to the E tranche, the over collateralization result, if you look at it, drops down all the way to 106%. That is because the E tranche is only protected by the equity piece. This is also why the rating is lower and why the basis points are higher, because it's more risky. All these numbers are negotiated. They set a minimum amount for the over collateralization test. So later on, I will explain how it happens, but if it fails, if that test fails, the A tranche has to begin to be paid down. So which provides further protection to the A tranche, which is also why it gets a AAA rating. Because if any losses start coming in at 126%, the CLO still has a lot of capital to pay down the A tranche. Besides that, you have other tests. Below that, we have the interest coverage test, which is also negotiated. It's a number that you will find in the indenture. The minimum is for the A tranche 120%. And that just means that it at all times has to have sufficient interest to cover 120% of the interest that is due to the A tranche. Again, if it goes below that, we reroute all of the other interest and pay down the interest to the A tranche, which provides it with protection. At the end, we have some recovery rates. The covenanted minimum recovery rate is also an amount, well, a percentage that is negotiated, and it is in the indenture. What that tells you is if a loan defaults, so for example, if a $100 million loan defaults, S&P in this case estimates that you will get 45% of that loan back. So if a $100 million loan defaults, S&P expects that you will get $45 million back, which further provides protection by making sure that on average, all the loans that the CLO is investing into has some sort of recovery, right? So if you think about it, let's assume that the minimum recovery rate is 50%. If the $400 million CLO, all of it defaults, assuming S&P is correct, the CLO will still have $200 million to pay back some of the A tranche. So ideally, the A tranche will not take any losses. And feel free to ask questions as we go. Yeah.
All right, so maybe it's the next slide, right? So let's think about from why would I want from, if I hold the loan, why do I want to put it, first of all, into the CLO to get it off my books? What's the purpose of me doing that? And then on the other side, as an investor, whether it be as an individual investor or as a corporation, why do I want to invest in that CLO?
Right. So first of all, the loans, it's just an entity that they need a loan. They go to a bank. The bank, they issue them the loan, but then the bank sells pieces of that loan to other entities, so to like Guggenheim. Why? Because they need the funds to, make more loans. So it's the same as when you buy a house. You buy a house, the bank gives you the loan, but then the bank turns around and sells that loan out to investors. And on the investment management side, an investor invests into CLOs because I have a great example. If you look at, well, I cannot share this, right? If I go to Google, I won't be able to share it.
I don't know if I see. I don't know if you share it with the screen. You can try, and that's okay. We'll see it here, and they'll hear it on screen.
Okay, because a lot of the investors were so a lot of the investors are large institutions, generally insurance companies, and a lot of them were foreign investors. If you look here at the German bond, the 10-year bond, the yield is negative 0.32%. Germany is rated AAA. So Germany has a AAA rating, but the yield is negative, which means if you give Germany your money, they give you less. So you're actually paying them to hold on to your money. But if you look at the current yields for CLOs, let's see. Where is it? So if you look at the current ratings up here, on the left side of the chart, a AAA rated CLO is paying 1.33%. So you can get into a AAA rated investment, same as Germany, but you're actually getting paid 1.33%. Whereas in Germany, you're only getting, well, you're paying them to hold on to your investment. This is why large institutions invest into CLOs. Because of the structure, you can actually create a vehicle that is as secure as the German government, which pays you a lot more. And in addition, this chart on the right, you can compare the CLO. These are the basis points that you can get in a CLO compared to other asset classes. So like in a student loan, you're only getting 37 basis points. In the mortgage-backed securities, you're only getting 43. On credit cards, you're only getting 28. On the CLOs, you're getting 118 basis points. And that's on top of LIBOR generally. That is why investors get into CLOs.
To beat a dead horse, can you explain LIBOR too?
I'm sorry?
Explain LIBOR, please.
LIBOR. LIBOR, that is the interbank rate. That's the rate that banks, issue debt to each other. They lend money to each other, and it changes daily. It's on Bloomberg. I'm sure you guys have access to it, right? And a lot of the interest rates out there, even in your credit cards, you'll see that the rate set by the credit card companies it's all based on a spread, which are the basis points on top of LIBOR. So it's a good measure for what the cost of lending is out there. And that is LIBOR. There are also other measures, but LIBOR is not the only one. And any other questions? Right. So they are, yes, they want the return without the risk. Correct. Yeah. And also, as you'll see soon, the investment manager, they actually manage the CLO, every aspect of the CLO on a daily basis, which is what I used to do. So if something starts going wrong, they know it, and then the investment manager takes action to correct it. You had your hands up?
So is it basically a bond then?
So yeah, so the CLOs, if you look at the structure here, from A through E, is like a bond. It's debt. When you invest into this CLO, you can buy any of these tranches. If you buy the A tranche, the CLO, the investment vehicle, owes you $278 million, and they have to pay you interest and the principal. If you own the equity piece, it's no longer a debt anymore. It's just equity, and equity pieces get whatever is left over at the end of the life cycle of the CLO.
While we're on that. Okay.
Correct.
So you were talking about, I guess, the risk and the risk profile. So the least risky is your A there. So what might be the difference in terms of yield from A to B in this?
Yeah. So the difference in yield is, if you look at the basis points, the spreads. In this example, the E is getting 600 basis points, which is a lot. I don't think even you can get that right now with high yield corporate debt. I think the high yield corporate debt is at 5%. Not that sure because I've been studying law recently, but that's the difference. Because it's riskier, you actually do get a higher return. But even the E tranche, right? Double B rated. What was I think we found. Well, this doesn't tell you the rates for a double B rated. Let's see, double B rated CLO rates. A lot of the information on CLOs is hard to find because it's a very niche market. So sadly, I'm not able to get you more rates, but Bloomberg should have access to it. And that's really the risk profile. It's a lot safer compared to other rates out there, to other investments out there. And the equity piece, to give you an example, I remember at Guggenheim, there was one CLO where they actually got, I think, 80% back. So their return was 80%, which is a pretty high return. The average in the market, I think, is 10% on stocks. And that is because if the investment manager does a good job managing the CLO, there is a lot of money left over to pay the equity piece, a lot of capital back. Any more questions? Nope. So I can keep going. All right. So in the indenture that I passed around, you will notice that there are sections for collateral quality tests and also sections for concentration limitations. And this is why I mentioned earlier that the investment manager does a lot of work managing the CLO, right? So what that means is they have to look at a whole bunch of collateral quality tests. I have another example of what that looks like here. Anything that I have in here, they're just some of the most important quality tests. There are a lot of quality tests, and I can pass this around so you guys can take a look at it. What the investment manager does is they test this on a daily basis. On a monthly basis, they send a report, and every quarterly basis, they also send another report. The collateral quality test allows the investment manager to make sure that they're investing into assets that meets the goal of the investment vehicle. Remember that all of the spreads, the ratings, the over-collateralization test, it's all agreed upon by all of the parties, and the investment manager has to make sure that it meets all of those tests. So here we have some of the tests. We went over the over-collateralization test, the interest coverage test, the minimum floating spread test. In my example, the collateral manager would have the obligation of making sure that on average, each loan pays a spread of 4.35% above LIBOR. And this is to make sure that they're getting sufficient interest payments to cover all of the liabilities to all of the tranches. The minimum rating factor test, that's just a way to give a number equivalent to the ratings and to get an average to make sure that the investment manager is investing into loans that on average equal a B rating. The minimum diversity test, the calculation is more difficult, but in generally, the higher the number, then that means that the more diverse your investments are. So you're investing into more entities instead of less entities, which is a lot safer for the vehicle. Minimum recovery test, we spoke about it a little bit earlier. That just ensures that even if a loan defaults, we are expected to recover some portion of that loan. So that on average, all of the loans have to have that minimum recovery rate. The minimum weighted average life test, in my example, is 7.5 years. And that's there because we don't want the investment manager to buy into a whole bunch of loans that will mature in 10 years. We don't want that because the CLO has a definite lifetime. It generally is only 10 to 12 years. And after the initial reinvestment period, the CLO has to start paying down the notes. So we cannot allow the investment manager to invest into long-term debt.
How liquid is an active investment?
So for they invest into private loans are pretty liquid. But if you invest into CLOs, into the notes, into the tranches, it's not as liquid. Only certain investors buy them. And when you're buying into a CLO, you usually either, if the rates are high, you can pay a premium, but if the rates are lower, you're usually getting a discount on them because of the lack of liquidity.
Can you explain that concept? So I think what they may not have seen or likely have not seen any of this yet. So explain that reasoning as if the interest rates go up now, what's existing is the first lesson.
Right. So for the price is based on several things. Just like any other debt out there, whether it's especially if it's fixed, right? If you have a loan, you buy into a loan, for example, $1 million loan, you buy it at par, which is at 100% of the price. So you buy it at $1 million and it pays you 5% in coupon payments. That's your return, the 5%, right? If the interest rates go up, let's say next month, when you want to sell your loan, right, which you just paid $100 million for, or $1 million for, if the interest rates go up and the new loans that are out in the market are now paying 6% in coupon payments, right? Why would anybody buy your loan, which only pays 5%, when they can go and for the same amount of money buy a 6% return? So if you want to be able to sell your loan, you have to reduce the price. That's why, in order to reduce the price to match that rate, to make sure that whoever buys it also gets a 6% rate return. That's what causes the prices of fixed debt to go down when the interest rates go up, or to go up when interest rates go down. Then liquidity is something else. It's all based on, you know, how easy it is to go out and actually sell it. If it's hard to sell it, you're gonna have to reduce the price in order to entice someone else to buy your investment. If it's easier to sell, then generally you will get a better price because there are a lot of people willing to buy it. Any questions about that? Peter? Good? All right. So besides the collateral quality test, there are also concentration limitations. And you may have seen some of these in some investment portfolios. I'm sure you guys have some concentration limitations here. These are just a few. On the paper that I sent around, you can see a lot more examples of these. But just to go over a few, the CLO, most of them can only invest about 90% into senior secured loans and only 10% into second lien loans. Senior secured loans are secured by a collateral. So when you have a house, you get a mortgage from the bank, but if you fail to pay, the bank can take your house. It's secured by the house. That's what we want for 90% of loans in the CLO, because we want to be able to take some sort of recovery in case a loan actually defaults. There are also limitations on the single obligor or any affiliates of that obligor. In this case, generally it's like 2%, 1%. It's a pretty low amount. There are limitations on how many CCC rated loans you can buy into. That is self-explanatory. CCC rated loans are very risky. They're more likely to default. To give you an example, I remember when I was at Guggenheim, Sears had a CCC rating, and Sears no longer exists. So it just took a few years for Sears to completely close all their stores. There are limitations on the geography as well. In my example, you can have up to 20% of loans that are from any entity that is domiciled outside of the United States. Same logic, outside of the United States is more risky, but you also can have limitations on specific countries. For example, in this example, you can have up to 10% of loans made to an entity domiciled in Canada. You will see that if you look at the list, there should be more countries, but I've only seen the US, Germany, Canada, the UK, and sometimes France and Italy. I haven't seen that many loans, at least that many investments into loans from like third world countries or countries that don't have a very good economy. And again, that's all there to make sure that the investment manager reduces the risk of the portfolio of the loans as much as possible. And what happens when some of these limitations are breached, right? It's easy to fix. All you do is, if by some sort of accident we invest 8% into CCC rated loans, for example, then the investment manager can just turn around, sell 0.5% of those loans, and then it meets the test again, right? If it fails any other tests, it has to do the same thing. If it fails the minimum floating spread test, if all of a sudden the average spread starts falling below 4.35%, it has to start selling those loans and buy into higher yielding loans. This is what my job was, to model it and then work with the traders and the portfolio manager to make sure that they can go out and buy loans that would meet all of the tests. There's one issue, however, when it comes to the over-collateralization test. If the over-collateralization test fails, then any interest and principal that is paid to all of the other tranches is rerouted and paid to the A tranche, to the most senior tranche. And the reason is because in order to calculate the over-collateralization test, you have to take into account all of the collateral available in the CLO. So if you have $400 million worth of loans, that's one of the variables in the calculation, $400 million. But if, let's say, $50 million all of a sudden defaults, right? If $50 million default, your calculation now only includes 350 million. If you turn around and you sell that, you're going to have to pay them. You're going to get the market value of that defaulted loan. So you cannot just easily sell the defaulted loan and get back all of the principal. Because if the market values your $50 million loan at $5 million, if you sell it, you only get $5 million back. If you hold it in the CLO, it's still only valued at $5 million. So it's hard to fix a failure in the over-collateralization test, which is why the CLO has a mechanism to reroute any principal and any interest, and it starts paying down the A tranche. And it does so because the A tranche is AAA rated and it needs to be protected from any losses. That's also why it has AAA rating, because if anything starts to go wrong in regards to the collateral, the A tranche starts getting paid, which gives more security to the A tranche investors. Questions?
So that's why you have that portfolio manager, and like that's why he sits there and you have your pool or your little jug of loans. If the loans go too low or too high, you have to buy or sell.
Correct, yeah. So we have to, everything is valued based on the market value. And we get market values from, what was it? Forget the name. This is entity. So there's an entity that provides market prices for loans, for private loans. These are all private. You're probably not gonna be able to find them just out there. They involve a lot of big entities though, like Sbarro, the Italian restaurant. I've seen a lot of their loans in there. Serpro, I think, Service Master, but they're big entities, they're middle market, but the way they raise funds is through getting loans. And if the prices fall, they have to either sell it or see what they do or refinance it, see how they work with the debtors. But that's what they do every day. You have the portfolio manager, the trader, and the people that model, which I was part of the team, and we all work together in order to make sure that everything in the CLO is working fine. The same.
And legal and the credit people too, right?
Right. So legal and the credit team get involved when it comes to any refinancing of the loans. So if the loan is not doing well and they want to refinance it, legal gets involved. Sometimes, for example, another entity besides, a subsidiary of Guggenheim would be the agent for the loan. They would be the ones originating the loan, so they can go. They have a relationship with the debtor, and they can just refinance it, or they can, do some sort of arrangement where they can work with the debtor. That's where legal would get involved. Any other parties would also get involved. The trustee gets involved, but everybody's working together because there are a lot of moving parts, and they all depend on, in that case, it was me making sure that the model was working well, because each of these CLOs holds like anywhere from 300 to 400 loans. So it's a lot of loans, and you have to make sure that all of the information flowed through the model so that you can see if all of the tests pass or fail. And if you look at the spreadsheet that I sent around, you have a column for the minimum requirement, a column for the result, and a column for whether that test passes or fails. And if it fails, then the investment manager has to take actions in order to fix it. That's also how we protect all of the senior tranches. We don't just leave the CLO out there. If something happens, then we actually take actions.
How much does an investment manager or / portfolio manager make of the CLO?
Like the person or the? Don't remember, honestly. They make a lot. I remember I was reading about one woman who was being paid a lot less, and she got a settlement for a few $1 million, which makes me think that she should have been getting paid close to $1 million every year. But that's the only thing I know about that, about their salaries. Yeah. The same thing happens with the interest coverage test. If the interest coverage test fails, all interest payments are rerouted to pay the senior most tranche. So the timeline of a CLO. Remember I mentioned that a CLO generally has between 300 to 400 loans. So it's not like the CLO gets formed one day and the next day they buy all of those loans. We actually, once we know that the CLO is in the pipeline, that they're forming a new CLO, there is something called a warehousing period, where the investment manager starts searching for the type of loans that they would want to for the CLO to invest in. So they start looking for all of the loans, and as they start identifying them, we start taking all the information from the loans and running the tests to make sure that once that CLO officially, is formed, it will pass all of the tests that it is required to pass. How it works is that the investment manager has separate managed accounts, which buy the loans and hold it until the CLO has the funds and the CLO can buy those loans from those other accounts. Once the closing happens, which is when all of the legal documents are signed, the CLO issues the notes. So those are the tranches, A through E plus the equity piece. And it gets the cash, it turns around and it buys all of the loans from the other funds. So that makes it easier because we have already identified all of the loans once the CLO is closed. As I noted earlier, there is a reinvestment period. The reinvestment period is generally 4 years. And any principal that is paid from the loans, the CLO is allowed to reinvest it into more loans. After the 4-year period, though, there is a post-reinvestment period where any principal payment repaid has to be used to pay down the senior notes, starting with the A tranche, then the B, C, D, E, and so on. Again, the CLOs don't last forever. So, the investors want to make sure that they get their money back. After the reinvestment period is over, the CLO automatically starts paying down all of the tranches. And a lot of these are just examples, by the way, the numbers and the percentages. Again, all of that is negotiated on the indenture. So it can be 4, it can be 4.5. Sometimes the investment manager has an option to extend it. It really depends on what's negotiated in the indenture. Once the payments are, once the CLO starts making payments, it all is based on the waterfall analysis. And the waterfall analysis is just really, it tells you the structure of the payments, how they're going to be paid, which tranches gets paid first. Generally, it goes from the most senior to the least senior. But you also have to take into account investment management fees. There are fees for the senior notes. There are fees for managing the junior notes. There are fees for managing the equity tranche. So the investment manager gets paid from each of those note holders. Depending on what stage they are in the reinvestment period or post the reinvestment period, some of those fees may be paid before or after some of the tranches. And it's all based on whatever the indenture says. But you also will have to model how the waterfall works. They call it waterfall because the water flows from the top to the bottom. And the type of investors that invest are large institutions. We noted earlier, a lot of them foreign, a lot of them insurance companies, mainly because of the low rates or the negative rates that are currently available out there in foreign markets. I also wanted to note, I noted that I work with private funds as well. And an example of a private fund would be, for example, a $1 billion fund, but instead of having 400 loans, it only has 7. So each loan is, $200 million, $100 million. So they are very large loans. It's a lot more riskier than a CLO because now your diversity is very low. Instead of having 500 loans, you only have 7. So a lot more risky. The structure is also very different. Private funds have some tranches that are pari passu, meaning they get paid at the same time. So for example, instead of D waiting for, I'm sorry, instead of E waiting for D to get paid first, they will both get paid at the same time from the same funds. They also have some tranches also have some characteristics of debt and of equity. And the equity pieces also have like different types of equity arrangements to them. Some of them are LLC interests. So the private funds are more complex, but that's just one of the examples of how they differ from general CLOs that you will see out there. You have a question? Nope. Okay. But generally, that's it. I just wanted to show you an introduction. Once you get into the calculation and to the modeling, it's a lot more difficult. But this is generally how a CLO looks like. If you have any questions about this or about my background or anything, just please feel free to ask.
So that structure could be applied to any kind of securitization process. So it could be replaced with corporate loans that you have here, could be replaced with credit cards or mortgage backs or mortgage, anything, right? Anything that you want to put in there as a cash flow you can replace.
Right. So, I mean, you can follow the same logic, and yes, but for the CLOs, though, you're restricted to what the indenture says. A lot of the investors, they want senior secured loans because there's collateral behind it. Also because there is the rates are higher. And remember that you also have the equity pieces at the bottom. The only reason the equity investors buy the equity tranches is because they expect a really high return. And you can only get a really high return if you're investing in a certain type of loans that yield a lot. So you can technically replace them with anything as long as you have the structure, but you would have to make it so that, you know, all of the parties involved, you know, are getting whatever they want from the deal. Yes.
So what prompted you to go to?
Yeah. So what prompted me was the fact that I was working with the indenture, with loan assignments, with a lot of legal like documents in order to understand the CLO, because I had to understand the entire indenture. I had to understand what everything meant. If you had a question, that's where you went to find the answer. And I work with legal as well closely. Guggenheim has their own legal department. And they also originate some loans, so they're very involved. That's why I decided that I wanted to get on the legal side instead of just reading the indenture and interpreting it. That's why. But it was all thanks to that exposure that I decided to go to law school.
I remember you said that, but you also had added the aspect of money.
Yeah, they also make a lot of money. And if you work in finance, you're gonna work a lot of hours, especially if you work in New York City. Work a lot of hours, but the legal side makes more. That's all. That was on my personal decision making. But I decided to go to law school mainly because of that interest, and because I was exposed to the legal side of these aspects. Yes.
So you're gonna go work for Guggenheim?
No, I worked at Guggenheim until the end of 2016. I went to Boston University for law school. I graduated in this May. So I'm starting at Lowenstein Sandler now. I will be there full time, but I won't be working with CLOs. I will be working in private corporate transactions. So private equity, mergers and acquisitions, combinations of companies, raising funds, sort of for like startups.
Do you have any expectations of what type of work are you doing?
So I worked at Lowenstein for the past 2 years. I was a summer associate in 2019 and in 2020, and I expect to be doing the same type of work that I was doing, which was, you know, I helped on a purchase agreement where one company was buying the assets of another company. I've helped raising capital, Series A, B, and C. those are generally for smaller companies that need funds, helps on mergers. And a lot of the work is for a junior associate is doing a lot of diligence, which means, for example, if a company is buying, company A is buying company B, you want to make sure that all of the, first of all, that company B has the power, to make the transaction, that everything, has been approved by the board, that whoever owns company B actually owns company B, whatever company B owns is actually owned by company B. So you're looking at everything. You're also looking at any contracts that need to get transferred and how that will work. That is all part of diligence. So you're looking at the contracts, the shares, any votes, shareholder votes, any decisions by the board of directors. That's all that the junior associate does. And generally, whoever is more senior is drafting, for example, the merger agreement. As a junior associate, you generally don't get to draft any documents as important as those. You do draft a checklist of anything that needs to get transferred on the day of the closing. For example, if you need to transfer a certificate of good standing, right, from the state, most of the cases from Delaware, you would have to draft a checklist that certificate of good standing has to be included in the list, and on the closing date you have to make sure that certificate is there and is valid. So things like that is what a junior associate would do. Yes.
So you would fall under like corporate law?
Yeah, corporate law.
And do they, when you went to law school, do they touch on corporate law, like the different branches, or like how is that?
Yeah.
Or is it just like general law?
Yeah, so at law school, they don't teach you they teach you the law, but they don't really teach you this, like all of the aspects of the law. They teach you more on how to think, how to think as a lawyer, which is you're looking at an issue and then you have to find a way to solve it. That's why they make you read a lot of cases. At Boston, we did take a corporate law class, and they teach you mainly like Delaware law, because that's what most people do in corporate law. And but Delaware law is similar to New York law, so that also works out if you're working in New York. But they don't teach you everything. It's all, they just teach you the general aspects of the law that most people know, that most people should be aware of. But the focus is on making sure that you understand how you would see problems for your clients and how you would go and find the statute and find the answer if it's corporate law. Just to give you a comparison, for constitutional law, you take a constitutional law class. A lot of the answers are in the Constitution, but you have to interpret it based on the cases. So they teach you how you have to go into, researching a whole bunch of cases to make sure that when you have a client with a problem, you can find a solution to your client. But they don't teach you like all of the law out there. They just teach you mainly how to think like a lawyer and how to process the issues to find answers for your client. Yes. Yeah, always. Socratic method, they make you read like 50 pages, like per class every day before you get to class. It's a lot of work, actually. To give you a comparison, when I was here with Peter, I was working, right, Peter? Part-time. And I did school full-time, and I did the competition. And I was helping my brother with his business. At law school, I couldn't work. I had to be completely a full-time student. The amount of work is just a lot, and if you want to get an A, it's a lot of competition. There is a curve. There has to be a curve in every class. If you have 20 students or more, you have to have a curve. That means, for example, only 10% of the class can get an A. Even if they're all good students, only 10% can get an A. The same thing with the B's. Same thing with the C's. So because there is so much competition, if you want to do well, you really have to focus on studying. and everything is based on your final exam. So you get one exam, 5 hours, and that's your grade.
That's it?
Yeah, that's it. It was really fun though. No, really. If you like, if you you know, if you're attracted to, you know, to problem solving, it's really fun. If you take the exams, like you know, if you take the exams and you take it like an opportunity just to see a very interesting fact pattern, and for you to apply the law, is very, you can do well. And the exams are generally they're open book too, so you have the answers in front of you. It's just that a law school exam is not, they're not asking you whether you know something. All they do is they tell you, for example, you know, Elvis was driving to William Patterson. He hit a pedestrian with his car. The cops came, they arrested him. You know, they search the vehicle, and then they tell you, the question is, you know, they give you like a whole page of a fact pattern with issues, a lot of problems. And then they tell you, talk about all of the legal issues and your solutions to them. So it's an open book exam, but the answer is not in the material. You have to take whatever law the material tells you and apply it to the facts that are, you know, that are in the paper.
So in this scenario, you would rather what if you had the authority to switch so far?
Correct. Yeah. So in that scenario, the first issue is I hit someone. So you have to go to whatever, you know, law applies, and see and discuss what, you know, what would happen in that situation. Then discuss whether, you know, the police could search my car, they could search me, whether they could take me in. All of that you have to discuss, but you have to first figure out what the problem is before you can discuss it. And when you discuss it, if you want to get an A, you have to always talk about both sides. So you have to argue for and against. Yes, never argue just one side. Always for and against, because you get points based on the discussion, not on whether you're right or wrong.
On this Socratic method, what was the one of the case when you saw the fact and they were discussing it, and you were in the court side?
Yeah. So the way that works, I don't see if, let me see if I remember a case, but I can tell you the way the Socratic method worked was the professor asks you a question about a case, and immediately after you answer, they tell you, okay, but what about this? So they play devil's advocate, right? They push for the other side of the argument, and they make really good arguments because they know the law. And you're a law student that doesn't know anything, you know, it really makes you question yourself. But the whole point is that you're supposed to be looking at all sides of the issue. One of the problems, I remember one case was, we read in constitutional law, we read Brown v. Board of Education, which was the, I'm sure you all know about it, the case about, I think was it separate but equal, where we were busing, you know, African-American students. Well, before we were busing, they were going to their own separate school, but nothing was really equal. So obviously that was wrong, right? But then the professor would take the other side and they will tell you, you know, but why was it wrong? Why? And if they're getting the same resources, how is that not equal? Where in the Constitution does it say that you have to have equality? So all of that, because somehow you have to tie the answer to what the Constitution says. And the Constitution doesn't say, for example, it doesn't say that you have the right to abortion, right? It doesn't say that, but somehow the Supreme Court found out that there is a right to an abortion within the Constitution. So that's what happens in the Socratic method. You give one answer and then they push for the other answer, and generally you're always going to be wrong, even if you're right. It's just meant to teach you the way you're supposed to think. All right. Any other questions? Are you all looking to go into finance? Okay. Yeah. If you have questions about that, I mean, I started at a bank in New Jersey, ended up at a big investment manager in New York City. If you have questions about how I did that, you know, I can answer them.
Okay, how did you do?
Yeah. I know some of you may be looking for jobs. It's really hard coming from William Patterson because it's not like a big target school for the big financial employers. But once I was working, I decided I liked CLOs, right? I decided that I wanted to go work with CLOs, but my background was more in analyzing, how to invest into a CLO, not how to, build one or model one. So I bought a book on CLOs and I learned how to model it. The book came with an Excel spreadsheet, which had a model already. And I learned how to model it. Took me a few months. And then I reached out to a recruiter. So I would say the recruiters are the best way to get the attention of the big companies out there, the financial companies, because they rely on recruiters, to bring them candidates that the recruiters have already vetted. And the recruiters also give you advice. The person that I work with, he gave me advice on my resume. He asked me, "Hey, Elvis, do you also do these kind of things?" I told him, "Yeah." He said, "Okay, change that because, at Guggenheim, they want to see this." So they guide you to make sure that, you're showing your best talent to the firm that will hire you. So it's definitely a good resource. They don't cost anything to you. How it works is the company pays them to bring in the talent. So in that sense, it works. And also because the pay is based on the salary, they generally push for you to get a higher salary.
So to toot your horn, were you the only one who got out of your first year an internship, after your first year of law school?
So yeah, it's hard to get an internship at a law firm on the first year. Generally, the first year internships are, for a nonprofit, for not even for a judge. Those they require more experience. Somewhere else at the school, or a lot of people don't even get an internship until their second year at law school. And even then, it's very hard to get an internship at a big law firm. But there were several people that got an internship after the first year. It really depends on how you do, though. A lot of it depends on how you do in your first year. If you do really well, you get A's, you're in the top, 30, 40% of the class, you generally end up getting the interviews for positions in a big law firm. That varies depending on what school you go to, right? Because if you go to Harvard, because of the curve, remember, only a certain number of people can get A's. That means even if you go to law school in Harvard, not everyone is getting A's. Only 10, 20% of the students are getting A's. But a lot more of those students get interviews at big law firms because they are going to Harvard. And it all depends, on which school you go to. So whether one of the top 14 schools, which are the top 14 rated law schools, or anything lower. If you do really well, you will have no problems finding an internship.
Lower St. Tyler's corporate law, separate wedge. It's ranked generally like top 25, right? Corporate law.
So,
Different
right, I'm not sure about the rankings, but it is it's like the top law firm in New Jersey. They compete with New York law firms. They have an office in New York, also in California, Washington. Depending on where you are, that's the kind of work that you do, right? In Washington, you're not doing a lot of transactional work. You're doing more like policy type of work. New York, New Jersey is mostly transactional. A lot of the people that work in New Jersey or in New York travel between New York and New Jersey because you're doing the same work, you're working with the same people. A lot of the partners end up moving from New York to New Jersey because the lifestyle is better and they don't have to commute to New York anymore. So they compete though with the big firms, and a lot of lateral hires are also from the big, like Kirkland and Ellis, like Cravat. But that comes later on as you get more experience. So, yeah. Any more questions? We can ask about anything. No, don't feel shy.
What do you recommend they do when they're here? make themselves, put themselves in a better position either for graduate school, law school, or a job.
Yeah. So for if you want a job, do more than just get A's. Uh, a lot of people go to school to get A's, but when you're doing an interview, you really want to, give them your story, right? What it is that you do. Are you someone that is here, you're the first one in your family doing something, right? Did you start a business on the side? Besides going to school, are you involved in any clubs? Just show them that you can take initiative and that, you didn't just go to school and didn't do anything else, because all of the other applicants are also going to be doing all these other things. They're going to be involved in clubs. They're going to be involved in other activities. So you have to somehow stand out. I would definitely say grades are just not enough. If you want to go to grad school, depends on what type of grad school, right? I can tell you, for me, I needed to go to work. I knew I wanted to go to grad school, but I couldn't afford to go directly to grad school. So I had to go to work, save up, get experience, and then ended up deciding to go to law school. But that experience helped me in the sense that I got a scholarship. That experience, that working experience helped me when I applied to internships, because, the people that were applying for that first year internship at Lowenstein were students that went straight from undergrad to law school, who had maybe a few months of work experience, whereas I already had a few years of work experience, and they tend to look that better. Definitely, if you can do that, I would recommend doing that, taking a few years work, get experience. They like people that are more mature, that are more invested into themselves, not just someone who went straight through just because they had nothing else to do and decided to go, to law school. There are a lot of students like that as well. But yeah, it really depends on where you see yourself also. I would definitely recommend, though, getting some sort of work experience.
We're
Yeah.
not gonna keep any more. I just want to say, like, what you've accomplished in a very short time, it's really impressive, and it's super tough. I mean, all of a sudden you got a scholarship to DU Law, which is top 20, top 25, but Lowenstein is super tough corporate law job to get, and if you look at what you're working on, private equity, M&A, that's the hardest job to finance to get. That's the top of the food chain. So doing that's pretty impressive, and very proud of what you accomplished. And thank you.
Yeah, thank you, Peter. No problem, man. I'm happy to help. If anybody wants to send me an email, feel free to ask anything, any questions about, everything I've done, how. A lot of what I did, I was the first one in my family to do it. High school, college, everything. So it's a lot of it is just learning to do it yourself. And when you go up to your interviews, if you ever have to do something, don't feel shy to tell them that, you didn't know anything, you learned it, you put the effort into doing it, and you've accomplished whatever you've stated, your mind to do it. They really like that a lot. But thank you. So, Peter, how do I? Let me log out from here.
Click OK there.
So the sharing session has stopped, right?
Bye, people.